Fraud. That's one of those words that just rolls off the tongue. Fraud. Why do companies engage in fraudulent financial reporting? By the way, this is just a very polite way to say, why do company managers lie? Fraud, one aspect of fraud is lying. Well, why would a company manager lie to make the financial statements look a little bit better than they really are? Well, they get a bank loan. We've got to get that loan to stay in business. You might lie in your financial reports to get the bank to give it to you. To attract new investors. Listen, we need new financing in this company. We lie a little bit in the financial reports. To increase our own bonuses, and this is kind of a nasty one. We're a corporation. We've got shareholders who aren't here on a daily basis. They can't see what we're doing. So to pay us, they say, we'll give you a certain fraction of the company's net income. Well, now we might lie about that net income to make it look higher than it really is so we can get a higher bonus. And we might just want to deceive our employees, deceive our suppliers, deceive government regulators, the public, all to make us look better than we actually are. That's lying. So there are many reasons why a company manager would want to lie using the financial reports. There are two major types of fraud. There's misappropriation of assets and fraudulent financial reporting, which sounds so nice. Hey, Mom, I engaged in some misappropriation of assets today and also some fraudulent financial reporting. Oh, son, or hey, daughter, that's not too bad. Well, really what you're saying is, Mom, today I stole and I lied. Well, that doesn't sound quite so good. Misappropriation of assets is stealing assets. Fraudulent financial reporting is lying about how your company is doing. So those are the two aspects of fraud, stealing and lying. So how do we minimize the likelihood of stealing and lying? And again, people are greedy. There are temptations. People are under pressure. Who knows when somebody might be under pressure and feel like they need to steal or lie? Well, again, the auditors. The auditors come in. They check not only the financial reports, but they check all the systems within the company and say, listen, are your assets safe? Are you doing the things that you need to do to both protect your assets, to avoid a misappropriation of assets, and to ensure the integrity of your financial system? Do you have those systems in place to make sure that there is no fraudulent reporting, or at least to minimize that impact? So the auditors, again, play a role here in reducing the likelihood of fraud. Market punishment. Boy, if you engage in fraud and then that is disclosed in the market, you watch your share price go down. Shareholders can lose millions, billions of dollars in one day if a fraud is discovered. So always when you're misappropriating assets, stealing, or engaging in fraudulent financial reporting, lying, if you're a responsible manager at all, in the back of your mind you're thinking, listen, if this gets found out in the market, our company's going down, our value's going down. So there's market punishment. And finally, there's legal enforcement. These are crimes. People go to jail for this. So that's another way that fraud is reduced. If there's a fear of punishment, the incident of that kind of behavior is going to go down. Auditors, market enforcement, and legal enforcement.